Hello, and welcome everybody back to Jesse Millionaire Finance channel. Hope you're all experiencing a tremendous day. If you haven't already, make sure you're subscribed and following. This channel delivers you the genuine crypto intelligence before it reaches the mainstream. Right now, there's an expanding narrative circulating across markets that we are officially in a bear market. Not exclusively in crypto, but across the broader risk environment. When you remove the static and genuinely examine the data, you begin to comprehend why this discussion is accelerating so rapidly. What matters is not the headlines, but the infrastructure of the system. Liquidity, employment, leverage, and confidence are all transforming at the same time. And when those four variables shift together, markets don't drift. They reprice. Let's begin at the macro level, because this is where every crypto cycle is initiated and ultimately resolved. Crypto doesn't exist in isolation. It lives downstream from global liquidity, labor markets, and the cost of capital. The US labor market has been the final pillar supporting the economic narrative. For nearly 2 years, employment data was utilized as evidence that the economy could withstand elevated rates. That illusion is now fracturing. US job openings have declined to levels not witnessed since 2020. In December alone, openings dropped by nearly 400,000, settling around 6.5 million. Over just 2 months, the decline approaches 1 million positions, a movement that historically only materializes during sharp economic slowdowns. From the peak in early 2022, job openings are now down more than 5.5 million. That positions them below pre-pandemic levels from 2018 and 2019. Even more alarming is the ratio of job openings to unemployed workers, which has collapsed to levels lower than those witnessed during the 2001 recession. This is not a soft landing. This is demand for labor evaporating in real time. Layoff data validates the trend. Over 100,000 job cuts were documented last month, making it the worst January since the global financial crisis. Non-farm employment estimates show outright contraction, with multiple months of job losses concentrated in government, hospitality, retail, and professional services. These are not high-growth sectors shedding excess capacity. These are core employment engines rolling over. When labor weakens, consumption follows, and when consumption slows, credit stress accelerates. That's precisely what we're witnessing now. Credit card balances have surged to roughly $1.25 trillion, an all-time high. This isn't discretionary spending. This is households utilizing revolving credit to survive rising costs of rent, food, insurance, and healthcare. Interest rates on those balances are north of 20%. That means consumers are trapped in compounding stress. Every month that rates remain elevated, the burden intensifies. Corporate balance sheets are fracturing as well. Large corporate bankruptcies are at their highest level in 15 years. Filings have more than doubled since the stimulus-fueled lows of 2022. That stimulus window is now fully closed, and companies are being forced to refinance into a substantially harsher rate environment. Commercial real estate is where this pressure becomes systemic. Delinquency rates on office-backed commercial mortgage securities have surged to record levels, far above anything witnessed during the financial crisis. These loans reset frequently, and when they do, the mathematics simply stops functioning. Banks are sitting on hundreds of billions in unrealized losses tied to these assets. That doesn't trigger a crisis overnight, but it quietly tightens lending standards, reduces credit creation, and drains liquidity from the system. At the sovereign level, the situation is just as strained. Interest payments on US public debt have exploded, particularly to overseas holders. The government is now paying multiples more in interest than it did before 2008, while total debt continues to climb. This is why rate cuts are not optional. They are mathematically inevitable. Now bring this macro backdrop into crypto, and the recent price action starts to make sense. Crypto funds have experienced sustained outflows, with billions exiting the market over recent weeks. This is not retail rotating. Retail has largely been exhausted for months. This is deleveraging. Bitcoin recently experienced its first ever single-day decline, exceeding $10,000. That move was not driven by fundamentals breaking. It was driven by leverage snapping. Funding rates flipped deeply negative. Implied volatility spiked above 90. Long positions were forcibly liquidated across derivatives markets. This was a full-scale washout. When leverage unwinds, price moves faster than sentiment, and when retail uses crypto as collateral, margin calls cascade. Those without additional capital are forced to sell into falling prices. Institutions, on the other hand, play a different game. They hold inventory, not just positions. They meet margin calls without selling. They use volatility as an entry, not an exit. That distinction matters. This is why consolidation accelerates during downturns. Projects without real balance sheets, real users, or real revenue simply disappear. Stronger players absorb the technology, the teams, and the infrastructure. Crypto does not die in bear markets. It evolves, and this is where focus becomes critical. The era of speculative noise is ending. What remains are networks positioned for institutional adoption, regulatory clarity, and real-world integration. This brings us directly to XRP. XRP exists at the intersection of payments, liquidity, and compliance. In an environment where capital is scarce and regulation matters, that positioning becomes increasingly valuable. As retail liquidity dries up, institutions become the marginal buyer. Institutions require clarity. They require scalability. They require integration with existing financial rails. This is why regulatory progress matters more now than ever before. Markets are forward-looking. They don't wait for legislation to pass. They price in probability. Political pressure is building. Economic stress makes financial reform unavoidable. Digital asset frameworks are moving from optional to necessary. This is not about ideology. It's about survival. In the short term, volatility remains elevated. Local bottoms form when leverage is flushed, not when narratives turn bullish. We may have seen that flush already, but confirmation takes time. In the long term, the direction is clear. Liquidity will return, rates will fall, balance sheets will be reflated, and capital will flow back into assets aligned with institutional infrastructure. This is how every cycle resolves. Bear markets don't end with optimism, they end with exhaustion. And exhaustion is exactly what the data is signaling. The question is not whether crypto survives this phase, the question is who emerges stronger on the other side. And that is where positioning matters most. When you zoom out far enough, the current moment feels familiar. Every major financial innovation has gone through this exact phase. Excess optimism, over-leverage, regulatory uncertainty, followed by consolidation and institutionalization. The internet went through it. Mobile technology went through it. Even traditional finance itself went through it multiple times. Crypto is no different. What separates success from failure in these moments is not conviction, but structure. Assets with clear use cases, regulatory alignment, and institutional relevance endure. Everything else fades. Short-term price action will continue to test patience. That is by design. Markets exist to transfer capital from the impatient to the disciplined. As liquidity conditions tighten, capital becomes selective. This is why broad market rallies fail, while specific assets quietly base and accumulate. XRP's long-term thesis is not dependent on retail speculation. It is tied to the modernization of global payments, the need for faster settlement, and the reduction of capital inefficiencies across borders. Those needs do not disappear in recessions. They become more urgent. Banks, governments, and financial institutions are under pressure to do more with less. Efficiency is no longer optional, it is mandatory. This is why the institutional angle matters so much. Adoption does not happen in bull market euphoria. It happens in downturns when systems are rebuilt. Regulatory clarity will act as the ignition. Once frameworks are in place, capital allocation models change. What was previously speculative becomes investable. That shift does not announce itself with headlines. It shows up in balance sheets. In the short term, expect choppy markets, sudden drawdowns, and sharp rallies that fade. This is price discovery in an environment of uncertainty. In the long term, expect a re-acceleration once liquidity returns. When that happens, assets aligned with institutional infrastructure will lead, not follow. This is not about predicting the next week or the next month. It is about understanding where capital is forced to go over the next decade. The data tells a clear story. Retail is constrained. Institutions are patient. Liquidity is tight. Policy change is coming. Cycles resolve when pressure becomes unbearable. We are moving closer to that point. Until then, discipline matters more than optimism. Structure matters more than hype. This is the phase where foundations are laid. If you understand that, the noise fades and the signal becomes clear. If you found value in today's breakdown, don't forget to like the video and subscribe. This Jesse Millionaire Finance, and I'll see you in the next one.